Deciding to remove your appraisal contingencies could make or break your next offer. But removing this contingency could cost you more than losing your next deal. Stay until the end of the video where I tell you who should or should not remove their appraisal contingencies. The primary purpose of an appraisal, in all honesty, is to protect the money the bank is lending you. The bank is not going to lend you money that they can't recoup should you default on your mortgage. Then why? So why on God's green earth would anyone be willing to remove their appraisal contingencies? Well, that's very easy. To get one up on the competition. You see, you've been losing out on all your offers, and you just received a counter from one of your offers asking you to remove your appraisal contingency. Oh no. You really want this house, but the frustration of losing offer after offer is starting to get to you. Okay, you remember when I told you that the primary reason for an appraisal is to protect the bank's bottom line? Well, not only does it protect the bank's bottom line, but it also protects your bottom line as well. It can help you from overpaying for a home. You see, by removing your appraisal contingencies, you're telling the bank and all parties involved that you're willing to cover the difference in your offer should their appraisal come back short. For example, if your offer is $600,000 and you're expecting to put down 20% or $120,000 for your deposit, this means your loan amount will be $480,000. But if your appraisal comes back for $580,000 and you want to keep the same 20% deposit, because you remove your appraisal contingencies, your down payment is now $140,000. So in other words, you're going to have to come up with the difference between the appraised value and the offer price. But there is one more option that can save you some money if you decide to remove your appraisal contingency. Your second option is to put down less on your down payment. Now this changes your down payment and increases your monthly payments and likely adds PMI insurance to the loan. But if you're not maxed out on your loan, this could work out best for you and your family. So instead of your down payment being 20% at $120,000, you would take $20,000 and pay the difference of the appraised value and the purchase amount. So now your down payment would only be $100,000 or 17.2% of the appraised value. Now, if I lost you, rewind the video and play it back at half speed. But seriously, talk to your realtor or your loan officer to see if this strategy will work for you. So is it worth it to remove your appraisal contingency? And the answer to that is, if you're strapped for cash and max out on your loan ratios, then you, my friend, should not remove your appraisal contingencies. But if you have the cash and you have a dope realtor analyzing your deal, I'm sure he or she can structure something that'll help you win your next deal. If you haven't yet, go watch my previous video where I give you 4 tips that'll help you get your next offer accepted. I'm Osiris, and planning your next move is easy with the right people in your corner. Peace.